So we'll start from this problem. So this is also a forecast SOPL and the effect on ratios. So we'll start from the required. Okay. Required for each financing proposal, prepare a forecast SOPL after one additional year of operation. Evaluate and comment on the effects of each financing proposal on the following. Okay, so it's going to be financial gearing, operational gearing, interest cover, and earnings per share. So we have to find out what is its effect on these numbers. So they say that Arvind plans to raise 5 million in order to expand its existing chain of retail outlets. It can raise the finance by issuing 10% bonds redeemable after 11 years or by a right issue or at $4 per share. Okay, so they want to raise this amount in terms of a bond or a rights issue, and the share price is $4 per share. The current financial statements of Arvind are as follows. So they have given sales, cost of sales, gross profit, administration cost, profit before interest and tax, interest, profit before tax, taxation, profit after tax, dividends, and the retained earnings. They have also given us some SOFP, but we don't need to forecast this. So they have given us net non-current assets and net current assets. So bonds they have given, and shares and retained profits they have given. So these are the numbers. So they've also given us some additional data. The expansion of business is expected to increase sales by 12% in the first year. Variable cost of sales makes up 85% of cost of sales. Administration cost will increase by 5% due to new staff appointments. Arvind has a policy of paying out 60% of profit after tax as dividends and has no overdraft. So there's no overdraft here. So the sales is going to increase after the expansion by 12%. Variable cost is 85%, so that also will increase by that 12%. Administration cost will increase by 5%, he says, and dividend will be paid from 60% of the tax of the profit. Okay, so that's about the concept here. So we'll start doing it. So we have to find out all these information. So to find it out, we have to find it out in two ways. So one is expansion through debt. So that's going to be one, and again expansion through equity, that will be another one. Okay, so we'll start. So sales is currently 50,000 here, and that sales is going to increase by 12%. All right, and they also say that the cost of sales is 85% of variable cost. So we can actually put it like this. The cost of sales has two parts. One is variable cost and the other one is fixed cost. Okay, so both see, the fixed cost is usually fixed, it will not change, right? So 15%, so 15% of the fixed cost is always, say, of the cost is always fixed. So out of 30,000, this percentage is fixed. And what about the balance percentage? Okay, see, the balance percentage, I think we'll copy like this. The balance is 85% is variable cost, and that variable cost will increase by 1.12 because it will change with the sales. Okay, so let's get the concept right. So we got it as 28,560. So let's get the gross profit. So we got our gross profit. Let's get the administration cost. So administration cost is 14,000, and that also is going to increase by 1.0. By how much it is increasing? It is increasing by 5%. Okay, 1.05. With this, we can get the PBIT. So gross profit minus administration cost is PBIT that we got. Then there's interest. So interest is where things get interesting for us, because if the company is going to issue bonds, okay, let's see whether the company already has bonds. Yes, the company already has bonds, so we have to do a working note here. Working note 1 we have to do. So working note 1, and this is for interest. Okay, so the company has to issue a 10% bond of 5 million worth. Okay, so we'll put it as new bond. It's a 10% bond of 5 million. So as we working out the sum in terms of thousands, okay, we can divide it by 1000. So whenever we work out, we have to mention that we are working out in terms of 1000. We have to mention that it's $1,000 we are working out. So the same concept is what is applied here also. So let's get the answer. It's a 10% interest and 5 million bond converted as thousands, so that comes into 500. So the old bond, so the existing bond we have to raise it. The existing bond, if you take, are 12% bond. Okay, 12% bond which we don't need to convert into 1000 because it is already converted and kept it. So this is the total interest, which comes to 800. So it comes to 800. So we can compute our PBT. So we can find out the tax. So the tax is 30%. Tax is not given here, but it is given here. Tax is 30% of this number. So we got our PAT. Let's check about our dividend, how much of dividend we pay. So dividend is 60% of the amount we pay as dividend. $5208. And the balance amount goes to retained earnings. Okay, so this amount goes to retained earnings. So that's about the expansion through debt. So now we can again find out what would be the effect on the if we are going to issue equity. Okay, so we can actually copy the entire thing, right? We can copy the entire thing, and or else we don't even need to actually copy the entire thing, because if you see, if we issue equity, the only difference would be the interest. Okay, interest we don't need to pay, but thereafter other numbers are like will be the same. Okay, so interest alone will be a changing number. So the answer would be up to PBIT, it is same. After the interest, the sum changes. So why should we copy the entire thing? So what we'll do, we'll copy the full one, right? Expansion through equity we'll put, and we don't need up to here because it's going to be the same only. So why should we need it? Okay, if you take the interest, so there's no new issue, so only the old interest will be paid again. So the interest is, the old interest is only 300, so we can take that itself. So actually your answer, will it change? Okay, see the answer will, this answer and this answer will not be same, because here there is an increased sales, increased admin cost, okay, increased variable cost are there, so the profit will be different. So we can't use the question number just to get it, we have to calculate it. Okay, so we have calculated it. So PB up to PBIT we have already calculated it above. This alone small change we have made. Okay, the interest alone is the small change that we have made. Okay, so let's check whether it is correct. Okay, so if you see, the tax is a different number, right? The tax is 7940. So that alone we have to change. Not that alone, I think it changes. So that changes, and the dividend is declared from this amount 5558. So we have to change that also. Okay, so the number comes to 2223. So our earnings that is going to go is 2223. So this is a change here. Okay, so when you change the PBIT is same, but when you change the interest, PBT changes. So tax will also change, and dividend will also change. So if you have worked out any formulas within this, then we don't need to work out separately. But to teach you guys, I have to do it like this only. Okay, so we'll move on to the next idea. See, the next idea is like very simple. Commenting on the ratios. So we will work out these ratios here. Evaluate and comment on financing proposal. Okay, so let's comment about it. So we have how many ratios? We have financial gearing, operational gearing, Okay, so we have these things. Let's get the formula here. Financial gearing is very simple. It's long term debt divided by equity plus reserve. Operational gearing is again quite simple. It is about so it will be contribution divided by PBIT. Then you have interest coverage. So interest coverage would be PBIT divided by interest, and earnings per share, it is PAT, profit after tax, divided by number of equity share. Okay, so that's about the idea here. These are the ratios. So to work out these ratios, we should have some headings. So we'll have the ratio name here. We'll have the calculation part, and we'll have the output of the ratio here. Okay, so I think you can start. So first we'll start from financial gearing. See, financial gearing, we have like two ratios here. One is for current we have to do. Then we have to do for the debt proposal. And then we have to put it for the equity proposal. Okay. For two things we have to find out. The same concept or the same idea has to work again. Okay, I think we'll start. So what is the current long-term debt? So we'll get the numbers here. Okay, so what is the current long-term debt? So the long-term debt is this number. So we have that 2,500 divided by equity and reserve. So equity and reserve put together are this number 22,560. After the debt proposal, what happens? The long-term debt will increase. Okay, it would have increased. So how much it would have gone? So we have to get the debt. So I think debt we could, can we get it here? Okay, so I think we'll get the new debt from here. See, new debt is 5 million. So new debt is 5 million. Let's see the old debt. Old debt is 2,500, right? Plus the new one. So new one is 5 million, right? So it is like 5 million divided by in thousands we are working. So our answer would be, okay, so this would be our new debt. Divided by equity. So equity will be like different. Again, it will be different. It will be 2500 plus, okay, or else we can put it as the same number, 22,560 plus the current amount that is coming from the reserve. So if it's going to be debt, then we have to get it from the debt area. So it is 2083.2. So it is 2083.2. So that's about the debt proposal. Let's get the equity proposal. In equity, the long-term debt is the same, but the equity and reserve will increase. How much it will increase? It will increase by what we calculated. We have calculated it already here. It is 222.3. Okay, by that it will increase. So it is 3.2, right? So we can get the answers directly. So currently the ratio is at 0.1 debt. Okay, we shall have to put a bracket here. Okay, see, in equity proposal, okay, as the number of shares are increasing, that we have to work it out. So we have to work out that, or else we won't get the answer. So number of equity shares issued, so that we have to calculate, or else we won't get the number. Okay, so number of new equity shares issued is, see, totally we want to raise 5,000, and if it's going to be raised by $4 shares, so okay, I think that's number of equity shares issued. What we want is, this will give you the total number of shares. Okay, equity proposal, okay, would be, see, the total number of equity shares will rise. So how much it will rise? It will rise by 5,000, right? It will rise by 5,000, the total amount. So now you just have to put it. I think you'll get the answer, right? You got the answer here. So this part you don't need to do it here. You can actually do it in the EPS. Okay, so hope you got the idea here. See, the current is long-term debt divided by equity plus reserve. In debt, it is old debt plus new debt divided by equity, reserve, and new reserve. Okay, and new reserve, which is like mentioned in this table. Thereafter, for equity, equity proposal, the old debt plus the old equity and reserve plus the new equity plus the new reserve. So we have got your concept here. So what does this indicate? Okay, what does this indicate? So it indicates that our debt equity ratio indicates that debt issue will increase the D ratio and equity issue will reduce the DE ratio. Okay, so that is what we can find out here. what it has reduced. Okay, so it will reduce it. So that it if you go for debt, see, the ratio can be 1:1, so it is not like very bad and all. The ratio is like comfortably within 1 only, so the company can go for debt. Okay, so the company is in a comfortable position to issue both equity and debt. Okay, so we can, if you want, we can check whether the profit is increasing or not. That you can check. So if you go for debt, actually it's the profit comes to 5208. So if you are in equity, it comes to 5558. So it is better to issue equity itself. Okay, it's not much tax benefit we are getting. So that is the concept here. So the next one is operational gearing. So we have to get contribution by PBIT. The problem is when we worked out, okay, we have only worked out in this manner, so we have not got our contribution. So we have to get separately our contribution. Okay, so we can work it out here if you want. So contribution is equal to the sales number minus the variable cost. Okay, so this is the new contribution. Let's see about the old contribution. If you take the old contribution, the sales is 50,000 and our fixed cost, okay, under cost of sales is 30,000. Or in our cost of sales, okay, 15% I think is always fixed. 15% is always fixed. So here also we have found out that some part of it is fixed. So 4,500 is always fixed, right? 4,500 is always fixed. So the balance, see, the balance of this is variable cost, and so if you divide it, you will get the contribution. Okay, so let's get the new contribution and the old contribution. Okay, we got both. So PBIT won't be a problem, that we can find out easily. So old contribution is 24,500 divided by PBIT. PBIT we have here. Okay, it is 6,000. See, whether we are going to go for debt issue or equity issue, it's going to be the same. So it's going to be 27,440 divided by PBIT. So PBIT is actually the same number. It is 8240. So it is 8240. Okay, so we can put it like this: the operational gearing of the company falls, which is good. Okay, so but it doesn't depend upon which operational gearing you want, right? Whether it's not about which financing policy you have. Either way you do it, it will give you the same answer. So let's go for interest coverage ratio. So let's check the current one. So this is like quite easy. So PBIT is 6,000, interest is 300. Okay, for the debt proposal we can get it from here. Here PBIT is 8240 divided by interest is 800. So you can get that and you can put it here. The next one is equity proposal. So you can again get it here. It is 8240 divided by 300. Okay, so we can put a comment like this. The debt issue reduces the interest coverage ratio to 10 times, but it is still comfortable. Okay. Right. You can also say that the equity issue increases the interest coverage ratio to 27 times, which is far than required. Okay, so it doesn't need to be 27 and all, because 27 seems to be like very high. Okay, so we'll go to the EPS. For working out the EPS, we need to know the PAT. So let's get the PAT. PAT here, it is 3990. Number of equity share is, we have to compute. Number of equity shares is 2,500 worth of shares are there, and each share is only 0.25 cents. Okay, so if you want, you can put like this. So the existing shares are this many, right? And the new equity issue is this number of shares are going to be there. Okay, post equity issue shares are going to be 11,250. So you can say that we'll get the PAT first. So PAT for debt issue is this number, and PAT for equity issue is this number. So we have got both. So let's go. Okay, will the number of shares change in debt proposal? The answer is no, it will not change. And the number of equity shares in equity proposal, will it change? The answer is yes, it will become 11,250. Okay, so let's get the answers. Okay, so we can give an argument saying that debt issue increases the EPS to 0.52, which is better than the existing EPS. So if you take equity issue decreases the EPS to, okay, is it decreasing? No, still it is increasing only. Okay, it is still increasing only. Increases the EPS to 0.49, which is better than the existing EPS. Okay, so these are the main points. So we don't need to give an overall comment. See, they are not asking for overall comment like which one is the better. They are just asking for individual comments. Okay, so in this kind of a problem, unless you know which numbers are going to go where, okay, if you couldn't find out that, then the sum would be like quite tough. Okay, so ensure that you understand where these numbers are going to flow and how they are going to flow. So only if you know that, this sum would be quite simple and interesting. Okay, so the sum is actually quite interesting sum, but the only thing is you should be interested in it. So that's about the concept here. Hope you guys got a good idea. We'll end this class here, or if you want we could just make a recap. So first try to adjust and get the SOPL for debt, and thereafter for equity you have to get it. Then work out the ratios. So we started with financial gearing ratio, then operational gearing ratio, then interest coverage ratio, and then finally we went to EPS ratio. Okay, for each one of it you have to give a comment, and we have also given the comment. Okay, so that's about this problem. We have finished our ratio analysis chapter.